The shimmering illusion, a hidden danger in plain sight. Many people look to silver. They see it as a bastion of safety, a tangible asset in an intangible world. For centuries, it has been money. It has been a store of value. People believe it will protect their wealth when paper currencies falter. They call it the poor man's gold, a hedge against the coming storm. But this perception, this widely held belief, contains a hidden danger, a trap. It is a trap that most investors, even seasoned ones, fail to see until it is far too late. The glitter of silver can blind you to the underlying mechanics of its market. This trap is not a conspiracy. It is not a secret plot hatched in a dark room. It is a feature of the market itself. It is born from the intersection of a powerful myth and a complex reality. The myth is simple and alluring. Silver is real money and will always save you. The reality is far murkier. It involves industrial demand, speculative paper contracts, and market dynamics that have little to do with protecting your family's purchasing power. The myth of pure safety, deconstructing the silver story. The central myth is powerful and deeply ingrained. It states that if the global financial system faces a crisis, silver will serve as a reliable store of wealth. This story is as old as civilization. It draws strength from the metal's long history as coinage. Roman denarius, Spanish dollar. Promoters of modern silver investment leverage this history expertly. They create a narrative where history is destined to repeat. As paper money loses value, silver will not only preserve wealth, but surge. You see it everywhere. Videos, newsletters, podcasts. The message is the same. A crisis is imminent. The dollar is on the brink. Your bank account could be worthless, and only physical metal will save you. These messages provoke an emotional, fear-based reaction. A constant drumbeat of alarm makes the myth feel inevitable. It makes buying feel urgent. The story becomes a simple battle. Honest people and tangible metal versus powerful institutions and flimsy paper. It positions the buyer as a savvy outsider with secret truth. Being in the know is a powerful driver. The myth is not just financial. It becomes identity, prudent, prepared, smarter than the crowd. But the story omits crucial details. It's a highly edited version of reality. It fixates on monetary history while ignoring silver's modern dual nature. The myth assumes safe haven demand dominates and pretends industrial forces are insignificant. This oversimplification is where the trap is set. Industrial chains and paper trails, the unseen forces at play. The first reality, silver's industrial role. Unlike gold, jewelry, and investment, silver is mostly industrial. Over half of all silver consumed each year is used by industry. It's critical in countless modern products. Your smartphone contains silver. The solar panels on your roof contain silver. Medical devices use silver. Water treatment systems use silver. Electrical components use silver. That link makes silver's price highly sensitive to the global economy. A vital industrial commodity, not just monetary metal. That creates a paradox. The crisis expected to boost silver often cripples industry. Factories slow, even shut. Demand for components plunges. Industrial demand for silver can fall dramatically. As demand falls, so can price. Silver can drop just when safe haven investors expect it to rise. The industrial chain can pull the price down. The second reality, paper contracts. Most silver trading doesn't move bars or coins. It happens in futures, contracts for future delivery. That market is massive and highly leveraged. A large trader can control positions far bigger than their physical holdings. Let us consider a simple, clear example of how this trap functions. Imagine an individual. We'll call him John. Concerned about inflation and banking stability, he becomes convinced silver is the answer. He commits significant savings to coins and small bars, certain he secured his family's future. His thesis: if the economy worsens and money printing accelerates, silver will soar. He holds it as long-term insurance. A global recession takes hold. Manufacturing turns negative from electronics to autos. Industrial demand weakens significantly. A leveraged fund faces a margin call and liquidates massive silver futures. The market is overwhelmed. Price plunges. 10% in a day, then 15% in a week. The safe haven story inverts before his eyes. Industrial collapse plus paper selling, a perfect storm. Then life hits. He needs cash. Forced to sell into the downdraft, he locks in a sizable loss. The insurance failed to pay out. His belief met reality, industrial demand, and leveraged speculation. Short-term volatility caused a real, permanent loss. So, what is the prudent path to protect wealth? Discard the myth and embrace reality. Silver is not a magical talisman. It's a dual-use commodity with a complex, volatile market. Powerful forces move its price beyond safe haven narratives. Base decisions on how the market actually works. Know what you are buying: a coin you hold, an ETF share, or a pooled certificate. Each has different risks. Investigate counterparties. Under what conditions can you take delivery? What are the costs? What if the provider goes bankrupt? Physical metal you personally hold removes counterparty risk, but not market price risk. The ultimate takeaway: caution and diversification. Silver can be a small part of a larger, diversified portfolio of hard assets, never the only bet. The trap springs when belief becomes blindness and you bet the farm on a single story. There is no magic asset. Build a resilient portfolio that withstands shocks from any direction. See silver for what it is: a volatile commodity with some monetary properties, not a guaranteed shield. Know the risks, see the trap, and choose to walk around it. The real value is in knowledge, not just in the metal itself.